Accordingly, the Governing Council today decided to raise the 3 key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand, and will also guard the approach. The Governing Council today also decided on the modalities for reducing the Eurosystem's holdings of securities under the Asset Purchase Programme. As communicated in According to Eurostat's preliminary flash estimate, the euro area economy grew by 0.1% in the fourth quarter of 2022 due to consumer prices. Price pressures remain strong, partly because high energy costs are spreading throughout the economy. Inflation, excluding energy and food, remained at 5.2%. Rising wages and the recent decline in energy price inflation are also set to ease the loss of purchasing power that many people have experienced owing to high inflation. This, in turn, will support consumption. Other indicators of underlying inflation are also still high. Government measures to compensate households for high energy prices will dampen inflation in 2023, but are expected to raise inflation once they At the same time, recent data on wage dynamics have been in line with the December Eurosystem staff projections. Most measures of longer-term inflation expectations currently stand at around 2%, but these warrant a weakening of demand would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's now look at the financial and monetary conditions. As we tighten monetary policy, market interest rates are rising further, and credit to the private sector is becoming more expensive. This partly stems from lower financing needs for inventories, but it also reflects weakening demand for loans to finance business investment in the context of a steep upward move in bank lending rates and a considerable tightening in credit standards, which is also visible in our most recent bank lending survey. Household borrowing has continued to weaken as well, reflecting rising lending rates, tighter credit standards, and a sharp fall in the demand for mortgages. As loan creation
the subsequent policy path will be decided in March. Are we just talking about the pace of rate increases, or could one potential conclusion also be that you have already reached the peak in interest rates at that time?
And we also made it clear that this would require rates to rise to sufficiently restrictive levels, and that rate increases would happen at a steady state. So we are really making that decision in that continuity that I have tried to explain. Steady state, we increased rate by 50% in December. We increased rate by 50 basis points in early February. And what we are saying is that as we will receive projections, we will need to assess what rates, what level, at what pace that we debated. I have to tell you that there was general agreement on the fact that the 50 basis point this time around and the 50 basis point in March were legitimate on the basis of, particularly in March, of the underlying inflation pressure that we know will continue. I think where there was not be doubted. Nor should be doubted the fact that once we are in restrictive territory, we will want to stay there sufficiently so that we can be confident that those rates will give us the return to the 2% medium-term inflation objective that we have. And I would say that all that we are seeing, which is a tightening of the financing terms and conditions, higher rates across the various sectors of lending, is actually good transmission of our monetary policy. It's not, and the balance sheet normalization is helping us normalize the process, and it's not the main instrument. It's obviously part of the accessory instruments, if you will, that come to supplement the interest rate policy that we have. And we believe that this impact is, in a way, efficient and necessary given what we are trying to do in order to reduce inflation and bring it back to 2%. Energy components, and we have to be attentive to the pace of transmission and the pass-through of those costs into other inflation component. But because my governors around the table of the Governing Council are genuinely interested in analyzing, understanding, and coming to as well-based conclusion as is possible, there was not a lot of discussion on that particular paragraph. It was a rather consensual assessment of the more balanced risk. At this point in time, we will obviously
President Lagarde, thank you very much for taking my question. I have one question on whether you're also discussing the negative side effects of your now policy raising rates substantially and very fast, especially on sectors like the real estate sector, and what it could also mean for the banks and balance sheet and consumption going forward. And then
on WebEx, what are we particularly attentive to in terms of inflation development? Now, obviously, we have to look at energy, because energy has been a key driver when inflation went up massively and went far too high. It is still far too high, by the way. So we have to look at energy costs because it might transmit, and at which pace we don't know, and we will be observing that very carefully, into underlying inflation elements. We are looking, as I just said, on the price of commodities. If you start looking at the price of metals in particular, there has already been an anticipation of how commodities are going to rise as a result of the Chinese reopening. So there will be inflationary, disinflationary forces, the exact detail of which I believe I will be able to say a bit more at our next March meeting, because we will be looking into that in the next few weeks.
Questions.
Good afternoon.
And the investors and the financial markets expect that the ECB will finish raising interest rate in coming April, for example, by the meetings in May. So, as you mentioned, I know well, so it depends on the coming data. But do you think such expectations are correct or wrong? Thank you.
You know, I'll go back to what we intend to do, or what we actually shall do, not intend to do. We shall return inflation to 2% in the medium term, in a timely manner. And we know that to those levels. And as I said, we are certainly not there now, nor will we be in March, given that we will rely on inflation, underlying inflation indicators and pressure that we see very, very clearly nowadays. In February, we're doing it, and we intend, which is strong, as I said earlier on, to do 50 basis points based on the underlying inflation pressure that we see, anticipate, and are not going to go away. I'm not suggesting that it will be steady pace for an ongoing basis. What we're saying here in this monetary policy statement is that we will assess the situation, evaluate our monetary policy path on the basis of our projection. Easier said than done, but it's important in those discussions and negotiations that there is a forward-looking approach to what inflation will be and how soon we will return it back to 2% in order to really appreciate the trend of wages that are discussed between the parties. Energy prices, you're right. But then we say, in particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. So it's not it's not asking governments to stop now, but they clearly have to align their fiscal support with the energy price impact at retail level when it comes to supporting consumers and at corporate level whenever it hits corporate. But it really focuses on in which way is this risk assessment more balanced. Not balanced. We don't think that there is symmetry of risk, but it is more balanced than it was back in December, for sure. And it lists the various points that are upside risk, downside risk on both account on activity and inflation. We have three, and then at whichever pace, in order to deliver on our 2% inflation target in the medium term that we want to reach in a timely manner. And we are far away from that. Inflation is still far too high today, in particular when we look at underlying inflation components.
The message you want to send to government, you said they should recalibrate. Is it really the right time to pull the plug when food inflation is at 14% and energy prices are indeed going down but are still hurting a lot of households? And the second